Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, November 8th, 2024. It's 10 o'clock a.m. on the button, so we're 30 minutes in the trading day, and I wanted to go over some trade ideas, trade updates, some of the things I'm watching, my thoughts. I'm going to start out here. There was a question put to me yesterday, and I can see 7 thumbs down, so I want to just clarify that and solicit some more feedback on this. So someone asked, do you have a limit or it maintains the market top range that we abandon the strong short thesis where it becomes probabilistic, not reasonable to hold or scale in from a short swing trade perspective? Great question. I'm going to even add to it now, add to some of what I said here. At this point, although we are there, we're pushing those upper limits of that. Really, the Nasdaq 100 being my big index. I'll get to that chart in a second. We're right there at the top. But no, I wouldn't at this point. With even though it may be noise, it may be faded. You had the post-Trump election, and I think most will agree. Trump is, if you want to say what you will about your candidate, but Trump's more of a capitalist, and Harris is more of a socialist. Again, so don't mean to offend anybody with those labels. So there's generally a belief that he's, going to have more market-friendly economic policies. He's more about deregulation and et cetera, et cetera. And so that's where we got the rally. Now, whether it sticks or not, whether other factors, which again I can talk on, watch that bond market. The bond market is probably not going to, especially in the longer run, like Trump spending. He's a spender. Don't get me wrong. He's not a fiscal conservative by any means. And what did he? I think 6 or 7 of his own companies have declared Chapter 11 bankruptcy. And I mean that's the way the U.S. is headed. So longer term, look, that's all long term stuff. And the bond market will decide. They call them the bond vigilantes. They'll decide when they think enough is enough on the ballooning this unsustainable trajectory the U.S. has on its debt. So park that for a while. Remember, that's not a day-to-day, it's a development you're going to look at, and I'll get to that. Let me actually add to my notes. I'm going to get to TNX because I can't overemphasize the importance of bonds. So to summarize, we're the price action over the last couple of days was nothing but bullish. I told you, I gave you a tight stop on that SPY short trade. It was literally a 2% loss, and and I talk on that in here and in my reply yesterday. Possibly this week, but most likely next week, we should have some color on whether or not the market will top around this level. I'll get to that in a second, show you why. Again, we're right there at the top of the range that I laid out. And those were weekly charts. Those go back to all the way back to late June. And today is Friday. So the 4 p.m. candle is what counts. And I'm banking on a red day today. Park us down right around the top of those ranges. Again, I'll get to in a second. Fed rate cut on deck today. Okay, so we already got that. So that was before the rate cut. With Treasury yields at key resistance, so waiting to see how the bond market reacts to what the Fed says later today. And you know me, it's not at 2 p.m. It's not even at 2:30 to 3 when Powell talks. It takes a couple days for everything that the Fed did and said for the market to kind of process, for all the market participants, individuals, computers, algos, everything. And so, yeah, unfortunately, I know a couple weeks ago we had the big, last week was big earnings. And I said, okay, it may take a week. And then, of course, as we got into this week, I'm like, yeah, of course, we have the presidential election and the Fed meeting, which is, that's as big as, probably as big as the big market earnings reports last week of the big Mag 7. All right, so, and this is what I want to impress. And, there's been plenty of longs and shorts, by the way, that have worked out. I'm updating trades today. Rocket missed Wednesday with 21% profit. Did the T3 to the button. I just posted you an update there. Plenty of longs. Like I said, if you look at, these little the indexes, I cover them because that is the stock market. That is bigger picture. And within there, we can lift up the hood and look at the different sectors of the S&P 500, the 11 sectors, or even the plenty of subsectors within there and kind of glean. But overall, you kind of want to typically align your trades with the trend. And the market, let's make no mistake about it. I'll jump back to this in a second. The market has been, this is QQQ, going nowhere now for months. This right here is late June, right there, early July, where it peaked, and we're effectively where we were then. We're within basis points or a percent or so higher, and so we've had a lot of mostly down, from that point there. So this is where swing trades in the market is one thing, and I'll always cover it, but it should only be one trade. And if you look at SPY, for example, I'm going to stick to that suggested stop I gave. I will always give you my thoughts on it. Whether, I might give myself a little more room than that or not. But it was a 2% stop out on SPY. And you look at things like the longs on Intel, we had two just in the last, month and a half, a couple months. The first one for 30%, the next one for 10% or whatever. That's 40% right there. So this is where you're going to make your money, especially, again, guys, in a sideways market right here that's had a lot of ups and downs. You're going to make money swing trading. And this is when flexible traders shine. Flexible meaning someone willing to go long, just as comfortable shorting a stock as they are going long a stock. And so, anywho, I just wanted to, again, reiterate, I will keep the trade ideas coming. I will keep a mix of those, as I always do. I always make it's not that I have to work hard at it, but, given a balance of long and short trade ideas, because when you expand not just to the stock market, individual stocks, different sectors at any point in time, some of which are bullish, some of which are bearish. That's why SPY always underperforms QQQ, because you have, steady eddy, dividend paying, defensive issues. QQQ is mostly growth stocks. So it's a growth index. When the economy is strong and the stock market's doing well, it does better than the S&P, because S&P has defensive issue and non-growth companies like utility and healthcare dragging it down on the upside. But likewise, when the market goes down, S&P falls less because those stocks tend to buoy the index. And so that's it. So we'll continue. I'll keep the trade ideas out there, long, short, commodities, bonds, different asset classes. And then this is what I wanted to see. I want to see how these weekly candles, because, the question was, I'm answering the question directly, unlike the politicians during the debate. The question was, talking about the long, this is my long-term thesis here, not short-term, near-term. And so that doesn't change until the weekly charts change. What does that mean? Let's just do that real quick, then we'll move on. Got a lot to cover. This is a weekly chart. This is the market top range. We're pushing the top of it right now. It's about 512. We're 512.91. Do the math. That's basis points. It's 1 point on a 512 point security. Is a mere fraction of 1%. So basis point is 1/100th of a percent. So when I talk about, trades, in basis points, that's what I'm referring to, the percentage. So for all intents and purposes, we're right there. And again, today is Friday. So we'll see where this candle, you have to squint to see it. There's this week's candle right. Oh, no, I'm sorry. I messed up. I'm on a daily. Let's go to the weekly. There's the weekly right there. This is how it was originally given to you. There it is. And there's that candle. No matter what happens today, unless there's some explosion to the upside, like a 3, 4, 5% rally, you're going to park, at best, you're going to park on the top of the market trading range. So here, it's simple, guys. How could my outlook, if it's based on technicals, how can it possibly change if we're still there? So that's why I wanted to address that. I don't get 7 thumbs down. That's it. Now, near term, yeah, you got to recognize the post-election rally. They liked Trump, the market did, and they liked the quarter-point rate cut, even though it was nothing new. They didn't sell it, but again, that ink hasn't dried on the Fed meeting yet, and we'll see if it's dried on on the Trump rally yet or not. But nothing's changed here technically. We did have a whipsaw, and that is a technical thing to note. We broke down, closed below the uptrend line last week on QQQ, and where are we at right now? And we took it back. So yes, that is a technically significant event right there. The divergence remains intact. But so here's my take, and I'll be very, very clear. I would not, even though we're at the top of that range, I would not short. I am not shorting. I've actually covered short positions in the last couple of days on the equity markets. I'm very light. I told you I'd be light into this week, and I'm going to go home very light. I need to see this market needs to show me its hand next week. And by that, if it can start to power on through here, start taking out divergences on starting with the 60-minute charts and the daily and the weekly, it doesn't mean I'm going to flip. I don't usually do that. Meaning immediately go from a bearish positioning and bias to a full long. Absolutely not. I may sit back. I still would maintain that any upside next week, any breakout above this range here will likely fail. That's my guess, but I need to see it happen. All right, that's it. So at this point on equities, I don't have any sell signals. I don't have you need to at least see here's a little near-term uptrend line. This is just a lot of noise, guys. We had, again, not just a normal run-of-the-mill presidential election, one of the most polarized elections in history, with the both the candidates being very polarized and the populace as well. You either I think most people, I believe, voted against a candidate, not for one. I know a lot of people love Trump, a lot of people love Harris, don't get me wrong, but I think there's a probably even larger portion that didn't vote for one or the other, but just voted against one or the other. Anywho, so again, markets don't care, really. That's the one thing. I've read about it and heard about it. Markets don't care who's president. It goes on, and right now, yeah, you can say the last couple of days they seem to care, but again, I've covered a lot of things in here. I don't want to digress anymore, including and not limited to my low volume indicators. That stuff doesn't go away when these things hit. And I didn't queue it up. Let me see if I can get it for you real quick. Yeah, I'm getting off track. I wanted to cover a lot of trade ages, but I have to, again, the low volume indicator is still very much in play. This is QQQ, so I didn't mean I had a video overlaying on this chart. Cover this quite a bit. You hit this level, we had that drop. We shorted, had a strong, very clear preference not to short the S&P 500, but to short the NASDAQ, which we did. We nailed it from high to low, and that was the first, at the time before there, I told you that my low indicator sell signal was firing, and it's fired again. And sometimes you get those double taps, and then that's when the reversal starts. And on SPY, especially the S&P 500, which has actually outperformed lately the NASDAQ 100, it's at an extreme low now. This is where usually the last time we had this double tap, we had one there with the shot across the bow, the second tag there, the yellow line, and that marked the top. That was it was technically a bear market, dropped into the 2022 lows, and this is it. So we had that. We got that first shot across the bow. It was only about a 10-11% drop in the S&P, but about a 16% in the NASDAQ, which we shorted, and now we have that. So all this, guys, the short term, oh my God, look how bullish it is because Trump was elected. That's just short-term noise to me. And again, it's worth noting because technically it did foil some of the recent breakdowns. But as I pointed out today on SPY, for example, and you decide whether you want to give it some room or not, even if you took it. So I'm typically use the NASDAQ, but I shared this one for you guys. If you're in it, again, I wouldn't add now. There's no reason. What you want to see is this breakout, this fail. You want to see it go back down. But what it is, no, that's the way I had it drawn right there. This is the actual trade right here. It's basically a breakdown of the back test of the trend line. We broke down there. We went down. We came close to T1. I can't remember if we hit it in the pre-market session or not. Either way, I'm not going to consider it hit. I don't see it. It doesn't matter. It's so minor a target. And that's basically a back test of the trend line. And so sometimes you break down and never look back. You're going to hit your targets. Of course, you have reactions along the way. And just as often, you break down a trend line, you go in and back test, especially in a pretty strong uptrend. So that's what's changed technically is really, like I said, we haven't taken back the trend line. It's just a bounce back and a back test. So enough on that. You do you on the indexes. But again, remember, there's infinitely amount of higher profits to be made trading individual stocks. Yes, things like SMCI and Intel and some of the high flyers and NVIDIA and all that, you have to, it's not as straightforward. You should beta adjust your position down because you have a lot more risk. Yes, somebody said in SMCI, they think it'll go bankrupt. I don't care. It was a reflexive bounce, and I got that post out to you this morning just to let you know my thoughts. That would have been my first target before. I should have highlighted the gap. Oh, now it's already gone. We hit it in pre-market, and that was right there. I got it out to you this morning. We're just off it, and so we pulled back. That was the logical. It's first resistance level. And again, you can call it a first target, whatever. It's, trade, I don't know, is up, 10% or whatever. We took it, it went a hair lower. But, from the daily chart, it still looks good because we're holding that support level. So what I'm done now, guys, I've segued in, I rolled into the trade updates. I wanted to cover this one. That was the big support level. You probably can't see it here. I'm going to make you see the lines a little better, turn it up. Volume price histogram. This is where almost everybody's traded SMCI in the last few years. You can see due to the volume price histograms being thick, very few trades occurred here. So that is and why all along that was my final target for the short trade, and it's massive resistance. It's price resistance. You can see it there, but the volume at price histogram bars help to see, and tell you too that we didn't just have a lot of trades in here. You can see we had trades, or we didn't have a trade that went on for a while, but a lot of volume. A lot of people bought that. It was a super well-defined trading range, powerful breakout, and we came down, and that's why the final target was at the bottom of that. So we covered the short, and then we went long. We had what I call momentum-fueled overshoot, one of the many terms I made up. When you have a lot of downward momentum or velocity, we were in a downtrend all along. It was somewhat orderly. It was powerful, but this is where we started waterfalling before earnings. That's a waterfall sell-off. And so that term I've come up with, momentum-fueled overshoot, it's just from experience. When you're heading down or on an explosive rally, you're almost always going to overshoot. If this is my target right here, you're almost always going to overshoot it if that's the resistance level I'm targeting, and then come back down. And same thing, we overshot briefly one day, the day of earnings, but then snap back, and we're above it. That's the important thing. We're right now, this is the line right here. This is the bottom of that trading range. And, I always use that pitcher throwing a fastball into a catcher's glove, how his wrist will snap back. That's that's what happens, and then it snaps forward right after he catches the ball. It springs back forward. So there's your momentum fueled overshoot. And so as long as you hold there, look, and I said you can, at this point, don't let it go. Don't let it get out of hand. That was the initial suggested stop, and you can keep that, or you can raise it, or if you're risk adverse, don't try to play this one. And again, you have different targets on the 60 or the 15. So there's SMCI. GDX, perfect reversal right off that level. GDX broke down the other day, as I've been warning of, most likely with these divergent highs. You had a gap down, 5% drop. Hit that first target there, 39.18, and I gave you this update here. We hit that 39.18, expected a bounce, and then a continuation down to the next target, which is 36. And that's what we got. Got a bounce, made it almost all the way up there. I had 38. I told you I would reverse just shy. I don't think I'd make it all the way to 39.88. We went as high as $39. So that's about, close enough, and so that should be it. Should be a rejection, and I'm not married to this one. There's still overall gold and silver in a longer term uptrend, but it's a well-defined uptrend line. And look, if we do, guys, by the way, if we do make another run up and make a full tag of the back test, that would also be an objective area to exit longs or add to any shorts. And so what you want to watch for now, we've already hit kind of where I expected, a little bounce up. You want to watch for a break of the recent lows. That should open the door to that move down to $36. So there's your update on GDX. Nat gas just continues to grind around. Remember on the futures, the long-term charts I've showed you, I don't have that queued up now. Still looks quite constructive, very constructive in my opinion, setting up for the next run. You had the breakout here recently, the 60-minute chart. You're still holding this support here on UNG. We just need to pop this level right now, 1311, the recent highs. Same thing if you're looking at the futures, just look for a pop of the recent highs. And then that should take us up to any or all of these targets and potentially these longer-term swing targets, which, remember, the futures are going to outperform because they don't have the expenses the ETF does. So that'd be about a 70% rally up to T8 from where we're at now on UNG, probably 100% or so on nat gas futures. But don't fall in love with the Widowmaker. She'll burn you. So set stops wherever your risk tolerance is. Beta adjust down. This is natural gas. Any trade. I don't care if it's corn, which I'll get to in a second actually. But if you're targeting, if that is your target, you may not be. You may just want to say, you know what, Randy, I'm happy with these little in and out swings. I just want to get 15, 20, 30%. So your stop is going to be commensurate with your target. The higher your price target is, the wider stop you can allow to give yourself a reasonable RR, risk reward ratio. So that's up to you where that's going to be. You can keep it tight, or you can have a wider stop, and that might keep you in the game. Let me see if we have maybe almost a additional downtrend line there forming. All right, I just want to say it's looks to be basing. Usually it comes down and pops, the trend line starts to run, but so I would like to see it pop that 1311, and that should get it going there. And the cannabis stocks, they obviously stopped out. I didn't put them on as an official with targets and all that. I just did a video, and that was pre-election. They popped out, and then obviously Florida here, at least, I don't know. I think it was on legalized at the state level on three state ballots, 3 or 4. I know it was in Florida. We shot it down. I think they had over 50%. Of the populace voted for it. Amendment, was it 3? Yeah, I think 3 was cannabis, or 4, 3. But we need 60% approval in Florida, so it got shot down. And so anyways, those are just, I mean, yeah, setting up. But, if you have any interest in the pot stocks, let me know. I'm moving on. They didn't pan out, and they would have exceeded any reasonable stops, especially when the breakout failed. Let's talk the commodities. I just mentioned corn. Corn still looks good. You had the falling wedge pattern here. This is CORN, the ETN for corn. Of course, you can trade corn futures, ZC. That's the pure play. Broke out. We went up. We hit that 18. This is the daily chart. Hit that 1882 level. Pulled back. We've been holding support here around 1744, but need to pop 1882. Still looks good. And now I'm going to show you something in just a second. Let me cover all the other grains at least, which are soybeans and wheat. This is what it looks like on the 60-minute chart. You had that bullish falling wedge I point out. You ran up there. That was a divergent high. We had a little one there that got bigger, and that's what did the trick. So these guys continue to kind of look like they're basing a lot like natural gas. I believe that's what's going on. I very much like the commodities arena longer term. I've been on that, harping on that recently. I'm going to show you the broad-based commodity ETFs in just a second. Just wanted to say that's what corn needs to do, pop 1882. Soybeans, SOYB, also looking constructive, coming off that divergent low. Breakout, rallied up. pulled back, but made a lower, so far, put in a lower high. And this is a 60-minute chart here. You had divergent low there. We hit my first target, effectively the second target, reversed a hair shy of it with that divergent high. But more recently, put in a divergent low here, and we're starting to walk up. So obviously, we need to break T2. T2, since we came so close, it's effectively been hit. Remember on SMCI when we hit T1 a week or two ago, and I came out, instead of just saying, oh, we're here, we may bounce, I give you my thoughts. No, I wouldn't game a bounce. I think we already came close enough to that first target anyway before, and my read on the chart, and it proved to be correct, is that when we came down here and hit first price target zone, I changed the green line. The first price target zone was that one, right? Yeah. And then I moved the lines around because then now it's a long. But so no, that was right here. It was down there. Okay, I must have removed. So when we hit that, I stated my preference to sit tight on the short, because I thought we would move down, continue on down, because we'd already hit it before. That's what it was, T1. And so we did that. And so instead of another bounce or reversing or covering a short, it allowed you to milk that extra or a good part of it, an extra 40% quick swoon down. And the same thing now with soybeans. That's what point I'm trying to make here is T2 for all intents and purposes was hit or close enough there. And so that opens a door that if we get there, and that doesn't mean we can't have a reaction, it's still resistance. It just increases the odds that we could go on through it without stopping because we already checked it once. All right, so that's soybeans, and then wheat. These guys tend to move together. Again, look for these divergent lows, rally. We hit 1, 2, all 3 of my targets. Reverse, had a divergent high, went down. Divergent lows, rallied, hit first target, hit my second target with a divergent high. These are all posted in advance. These were all official trades, and still are. It's one big longer-term trade too. I think it makes sense to have a portion of commodities. And you can go with the broad-based commodity ETFs. I'll show you that. DJP is one of them. I've highlighted this one quite a bit, and I keep highlighting when we pull back here to this level about 29.32, as I did back here, with positive divergence. It's a wash, rinse, repeat. Now each time we go up. We've been trading in a range, but it's a range I maintain when I look at DJP or any of the commodity ETFs. There, I got another one I can show you. This is a good one because it's a little bit cleaner board. DBC, it's the Invesco Deutsche Bank commodity tracking ETF. So it tracks some broad-based commodity ETF index. Just a beautiful bullish falling wedge. We had a big bear market in commodities. It ended when the stock market bottom when COVID hit. There's March of 2020 lows, COVID lows, and that's when I got very bullish on commodities. That's the inflation trade. That's what Powell and company just completely couldn't see. All they had to do is sit there and take the time to, either go to the grocery store, which they probably don't do. They probably have their personal shoppers, or look at the, price of milk and eggs, everything going up, or just, look at the charts, look at what oil is doing. And so they were in denial, and that's the whole, they got behind the curve, and then they started realizing it wasn't transitory and had to do the biggest rate hiking campaign in nearly half a century. And we all know where that went. Now, what it did is, look, this was going to correct anyways because nothing goes up forever. We hit nice resistance. This is a broad-based commodity index. We corrected. And I've maintained all along that by every metric, the downtrend line being broken, taken out, the primary bear market downtrend line, that comes back from 2008 right here. That being taken out was the first indication we're probably in a new bull market. The charts, even before we got there, it said probably. We had big positive divergence. And then you started taking out previous reaction highs. This one, then this one, then this one. That is the making of a new uptrend when you start making higher highs and higher lows. And so I have maintained and still do that this was the first leg up in a new bull market. We're talking commodity prices, which means inflation, higher rates. This was a corrective wave. We had a little bullish falling wedge right there. We broke out. There was a nice rally. but we came down and we made marginal new lows, but we're still well above all these previous lows. In other words, there's no, at this point in time at least, there's no threat to my analysis or the outlook that we're going to break out and do this. If we fall back below this level, yeah, something else might be going on, because that's where we broke out of this powerful basing pattern there. So we could do that, or we could break out sooner. I'm leaning that way. One reason I'm leaning that way, if you recall, let me see if I have a screenshot up. Yeah, here we go. Back in 2022, I started doing this. When this happened, when Powell was in company were in denial that inflation was ripping through the economy, I shared this negative feedback loop I created. And so what I said is, stocks will rally, and here we are right now. But then it's a loop. So first of all, you have these rising commodity prices, which are inflationary, causing higher rates and stocks to go down. Okay, that's what happened right here. When this happened, that's when, remember, we had the bear market with the drop off the early 2021 highs into the 2020 October the 2022 low highs, beginning of 2022. Yeah, the highs in the end of September. It was September or August in, I think, QQQ. And then the S&P peaked right after that in the very start of 2022. So that was the bear market there. Again, it was a bigger bear market in the tech-heavy NASDAQ 100. And that was when the market finally realized we had inflation and Powell had to start cutting rates. So let's go back to the commodities. DBA. And you can see there both, you have these downtrend lines right here. That's not what I wanted. This line right here, you have a nice downtrend line coming off a divergent low. And so if we pop that, and DJP doesn't have the same downtrend line. You'd want a DBC is better in my opinion anyways. DJP tells me it's an ETN. Then you get the K1s kicked out. But either way, you have this trading range wherein they're both similar. But again, DJP, the other one, DBC, is an ETF. And so you shouldn't have to deal with a K1. Either way, constructive charts. And like I said, that's where right now I think it's shifted to the RR is shifting pretty rapidly from an extremely overvalued stock market, again, with clear divergences and technical postures says they're going to get a correction. And commodities look like the opposite to me. Look like they're setting up for breakout there. And remember, I've been highlighting these both as active trade, swing trade opportunities, based on those 60-minute charts, as well as longer term trades. And that's what, if you're looking long term, again, I'm speaking now to the IRA investor, 401k investor, or someone that's not wanting to wants part of their money that's not in their active trading account, the longer term funds. That's where I'd be looking at a move all the way back, at least up to those previous highs there, right there, about 30. And then ultimately, again, if this is just leg one up in a bull market, just like this was leg one down in a bear market, you get a counter trend corrective wave, and then the next move continues. And we could easily come up here. And from a long-term perspective, if you want to put it in an RR perspective, I've been highlighting the most objective entries here at the bottom when we have these divergent lows and where we keep hitting support. So that was the last objective entry, about a 15% downside if you want to stop out below 18, compared to about 120% upside. That is an excellent RR, risk-reward ratio. You look at the stock market, I can all but guarantee you there's not 100 and something percent upside. At least, it's possible we could have some kind of crazy blow off top. I don't see it. It's just not in the charts is why. It's just not there. Okay, and now Treasury bonds. We'll just focus on the 10-year. Keep this video relatively short. Remember, this is the new trend line that I changed the other day. I had one here, but I told you I modified it to the BOD. The uppermost comes in and catches that reaction high perfectly, and we did reject off there. As I was making it, we were on that the other day, and now we have a reaction. So this is the downtrend line. So this is where, and as I said, I expected a pullback. Now the $1 million question, is it going to be a complete trend reversal? This, guys, could I'm put a little asterisk in there, could and should support a rally in equities that takes the stock market much higher. In other words, we break out, the NASDAQ breaks out, we go up another 10-20% plus. That a drop in yields could be supportive of that case. However, where that asterisk comes into play is, as I've talked many times, we'll likely see this if the stock market peaks and we have a substantial correction, one that takes us down to my deeper, longer term targets. In other words, if the stock market drops 20, 30, 40% or more, you're going to probably most likely get this anyways from a flight to two things. Number one, a flight to safety bid. If equities were to go down, and especially stocks tend to fall faster and they rise, they start snowballing down. You're down 10, 20, and then all of a sudden 30. You're going to see institutions getting the hell out of NVIDIA and Apple and Facebook or Meta and all that, and moving into treasuries. That's what we call a flight to safety bid. They have to protect what they have. They have to make a shift. Pension funds can't just buy and hope like individual investors tend to do. They will shift and they will cover their reduce equity holdings and buy treasuries. So now if it happens organically without a market crash, because Fed engineers it or whatever reason, market forces bring longer term rates down, that would be help to support these super high equity valuations we have. So again, if it's orderly and organic and anything other than a crash, that would support a move, a drop in treasury yields, the 10-year yield. However, if it's due to the market heading, in crash mode or strong correction mode, then that wouldn't be. So all I can tell you now, so there's a scenario, like I said, and I outlined. It's not double speak at all. It's just if we see rates falling because of this, then that's bearish for the market, or some market's already bearish, and that's what's the end result of treasuries due to the flight to safety bid. But if it's organic, then that should be net bullish for equities, should help support equities. But there's no scenario I have here other than one. If we break out and we take out especially these previous highs here, and then we get anywhere near, that was the peak in yields, multi-year peak right there, especially above it, I struggle to see that as anything but very, very bearish for the stock market. You can almost mark my words on that. My convictions are super high that the market will not tolerate, because everyone expects this. They expected this back here. This is when the Fed cut right here. This is right here. That yellow line was the last cut. So let me put a line here that we just had yesterday's cut, and we'll watch this. Now again, technically, I made the case, and remember, I made the case, and we were short. We shorted bonds after the Fed. Remember, that was an actual official trade. So it's not like in hindsight, I could tell you, like a lot of people, wow, the Fed cut, but rates went up. I expect them to go up. We rode that up. We shorted bonds as yields were coming up. It was in the technicals. Just like in the technicals now, the odds favor, but I'm not married to it. We so far had a reversal there, and now we've taken out this trend line here. And so I think we'll get at minimum just a reflexive, because we're very, very, very overbought. PPOs rolling over. There's a lot of evidence to go long bonds and short the yield, which is shorting yield. But will it be this as the Fed wants? And again, or is it just going to be a quick, correction that helps alleviate these overbought conditions, and then we go on and we continue to rally? I lean that way. I'm leaning that way because it meshes with my outlook on the equity markets, and what would most likely derail the stock market. all I can tell you definitively is watch that trend line. I can't, and watch, you can watch this day by day. You can be, if you are still short the equity markets, generally, index QQQ or SPY, I think a long in treasuries is a great indirect hedge. Why? Because if you're short the equity markets and yields drop, your bonds are going to go up. So being long the 30-year bond right now, you're going to profit, and that'll offset any losses. If you beta adjust, you need at least 2 times a position in the treasuries than you would in the S&P 500 because they have lower volatility. They move up and down less and less. So, if you're short equities and you're losing on that, you're going to make on treasury bonds. However, if this turns around and yields go up and your bonds drop, then the stock market's going to recognize that. We're at that point again. Just the recent lows right here. This is turn it upside down as IEF, and then we hit that trend line right there. There's the recent lows right there. If we take that out, that should be the number right there. It should be a line in the sand, because I showed you the trend line on TYX or TNX, which is the yield of the 10-year, and you can see inversely you have the same uptrend line, and there's the breakout right now. So, I've been making the case, we've been having the positive divergence on the 60-minute chart and uptrend line support on the daily chart, and there it is. So this is the yield, and that's the 10-year. You get more juice, remember, if you trade TNX, TLT, the 30-year bond. It's up 3.2% since that recent divergent low. All right, guys, lots of stuff there. And again, the market is a complex machine with a lot of moving parts. If you want to keep it very simple, you just watch right now Treasury bonds, the levels I mentioned, and developments, and the stock market. You can watch that. You get a little more granular like me. You want to watch different sectors, especially those that have the biggest impact, financials, tech. And then at the end of the day, diversify, spread your bets. Hedge when you can. Me, I've said many times, I don't usually do direct hedges, which is if I'm long the indexes, let's say I'm long QQQ, I don't buy QQQ puts. It's a waste of money, especially unless volatility is real cheap. The puts are cheap, but it's an offsetting one-to-one hedge. If I don't have enough confidence, I can just get out of the trade, or what I like to do is indirectly hedge, and that's what I showed you here. And we've done this many times throughout the year so far, and I believe they've all worked out. In some cases, they worked out even, and quite often they do work out even better, where we've made money on both sides of the trade. So that's why I like those indirect hedges. I will only do those when I can make a case, for example, to be short the equity markets based on their own technicals, and then long treasury bonds on its own technicals. And so then that works where I can actually profit on both of them. We've had some of those trades even this year. All right, so I'm going to wrap it up here, get the video out to you. If there is a trade idea that I've covered and I haven't updated, one that I threw out recently, or anything else you want, just put it in the comment sections, and I'll be glad to get back to you. This has been Randy Finney with Right Side of the Chart, and have a great day.